Hello.
If you guys are listening, as usual, some tech stuff.
Yeah, I can hear you,
Okay.
Doc. Can you hear
Okay,
me,
good.
Doc?
Now I can
Hello.
hear you. I had the wrong device in my ear for a change.
So you can hear me.
Yes, and we're live on YouTube, so everybody can hear us. Okay. Um, good morning, everybody. A little tech stuff, and now we're ready to go. Okay, see that? They shouldn't have taught me how to do that. Okay, hey, Val. All right, so let's get started here. Seven Angel, right? And I certainly have those dulcimer tones, that newscaster voice. Okay, share screen. All right, good morning, everyone. I don't know how it is where you are, but it's 11 to 13 degrees here with a wind chill of 1. It's actually kind of nice. Anyway, so here we are, 6950-ish. Um, Options expiration pin right in the middle of the 6900s, 7,000 zone that we've been bouncing around in. And gee, what a shock. Okay. Quick review, and my note was a little jumbled. That's kind of the way I phrase shit. Pardon my French. So Thursday was just can't kill the beast day. What I mean by that is, we had that ugly day Wednesday, and we managed to close over 69.25, around 69.25. And we kind of had that gap opening, almost, went up right near the all-time high, right around 80-ish. The all-time intraday high was like 86, 85, we'll call it. And then we just kind of, came all the way down, almost filled the gap. So I don't know if the gap fill gang counts that as a W or counts that as a gap still to fill. Of course, there's other gaps down here. If you worship at that church, there's another gap down here from 68.85-ish, kind of where we had that reaction last time, which also happens to be the 20 DMA. 20 DMA is important, daily moving average. And we have, so that gap was a 20-point gap. And we have the Thanksgiving gap all the way down there. So depending on which gaps you like to watch, and there's even a December low all the way down here. So that's kind of longer time frame. Anyway, so let's get back to where we are for the 6950 pin. And so let me get back to my somewhat jumbled notes. And this actually, I think I just put the day before stuff in there, so we're going to ignore that. Well, I'm going to ignore that. I put the wrong part of the wrong note in. Anyway, Friday, but the right note is in my Discord. Friday, and on a few other Discords. And I think I put it out on Twitter too. Friday today is options expiration, AM and PM expiries. I think the biggest story is the January leaps. Just like the institutions live in December for SPX, they live in January for leaps. or with various, whatever they're doing, whether they're hedging, whether it's stock replacement, whatever it is. The January leaps are the biggest single stock expiry on the board always. And so all that evaporates today. I'm sure a lot of hedges have been reestablished. I didn't, over the last few days, whatever weeks, I haven't gone down that rabbit hole yet, but I will this weekend if I have time. So that's just the storyline. And we'll see after options expiration today in both the SPX and in the single names, how all that unfolds. We have the unclenched, and we have that unclenched. We have the VIX unclenched next week with VIX-free, and we have earnings coming up, which leads into the dispersion trade, which I talked about a little bit in a post yesterday, and I'll probably do the little lengthier version of that in the weekend note as well. So anyway, today's game is simple. Respect the rails, post MOPEX, or tape either unpins like a professional or brace levels like install something clever, right? So today we have UMISH consumer sentiment at 10 a.m. We have the whole MOPEX thing. We have some earnings. And next week we have Netflix coming up on Wednesday along with VIX-free. We also have, I put it in my note at the bottom somewhere. We have the YLD flow. At the money calls in the indices and the MAD names are being sold today. So if you remember, I mentioned yesterday the QYLD role, the YLD family of funds just does the Qs, they buy back the in the money calls, or the calls, whether in the money or out of the money. They don't do it on the other names, but today they sell at the money for next month expiry, the AM for the indices, RUT, NDX, and SPX. The SPX is around 6 billion-ish, I think. And plus in the single names, NVIDIA, whatever they have, NVDY, they have all these yield match funds. And so that's something you just have to keep in mind. Okay, so let's look at some of the zones. Oh yeah, I thought this was interesting. So let's look at kind of the levels and lines again. 5-day range, 85 to 85, roughly 100 points intraday range, but basically in a week we've gone nowhere. So even though it feels to us, to some of us who are sitting there day to day, wiggle to wiggle, 5-minute candle or 15-minute candle to 15-minute candle, it seems like we've done a lot. In reality, we just bounced around within the expected move. Volatility nothing realized within this week. This is Friday to Friday expected move. Oh, we touched the bottom where that 20 DMA is, whatever. We undercut it, and now we're just we've basically been treading water. Indecision. Do we unclench next week somewhat? I don't know. We'll see. The positioning will tell us that. The positioning will tell us that. TGIF, right? What a week. What a week. What I wanted to show you. Oh, yeah. I'm going to switch gears for a second here. All right, this is the PM, which is what we're going to have to be dealing with after we look at the AM. After the AM, we're going to look at the AM briefly. Well, maybe not that briefly, but let's look in depth view for a second. Okay. So here's what's at the 7,000 right now. There's 50,000 market makers have in their possession. I don't care, quote unquote, what your open interest says. Open interest is what's open. If I did a trade and I have 10,000 open, and you did a trade and you have 20,000 open, and we're on the opposite sides of that trade, and the dealer bought them from me and sold them to you, or vice versa, they're not open for them. Conversely, if I sold 50,000 and they're open, and you bought and yours is open, whatever it is, that's what the dealers have. Okay, so what the dealers are sitting with is basically nothing, because they have we have a synthetic short of roughly 50,000 contracts right here at 7,000. That's what they're sitting with, which goes away at the end of the day anyway, so it doesn't really matter. I mean, when we open, so it doesn't really matter, other than intellectually it matters. So that's what's sitting in the dealer's hands, according to the CBOE, who knows what's in the dealer's hands as of this moment. Okay. And so all this is going away. And as you can see, most stuff has been rolled. Most of the stuff has been taken care of. There's really not a lot left going on. And so in my little thing, I should have said, MOPEX, insert hyperbolic statement here, because everybody likes to say X trillion dollars worth notional, whatever it is. Well, most of it's gone, most of it's hedged out, most of it's out of the money, a lot of it doesn't matter. So I'm not going to try and get clicks by, making these kind of statements that kind of are meaningless. Okay, so getting back to the dashboard for a minute. Now let's take a look at the AM, just for fun, now that we got that out of the way. Let me get rid of, well, actually, I'm going to leave the markers in. So here's what's in the AM right now. We got this up here, which decays down. Negative gamma above. Storm pushes it, that pushes us down. We have basically stuck in this whole little positive gamma soup right here. And that's it. So that's why we're kind of stuck right here. This is pushing us down. This is pushing us up. Everything's been hedged out already, and we close and we open somewhere in here. Give or take 5 or 10 points. We're gonna open somewhere in here. Okay. And it wasn't really hard to call, I think. Okay. So now let's look again, and we kind of looked at it briefly a minute ago. I guess widen this out a little bit to 30 on top. This is kind of a little too far on the bottom, but we'll leave it there for fun. Okay, so this is what we're dealing with today. After expiration, we open up, we wiggle a little bit, and here's where we are. So my eye catches this, 69.
So, just to make sure, we're looking at PM or AM expiration or both? What?
Well, right now we're looking at PM.
At PM. Okay, thanks.
Okay, you're welcome. So I showed you AM before. Now that's going to be gone. So now we're going to PM. And so PM kind of looks interesting here. Not what one would expect, or I don't know if you had an expectation. So we have 69.20 and 69.60 negative gamma, kind of choppiness, potential magnets toward those areas when we open up, and we're going to kind of open up probably somewhere around here. So with a little weakness, but notice that these are small, so there's really nothing to hang your hat on here. There's really nothing to hang your hat on over here. So 69.20 on the, if we head down, gap fill gang could take a bow, or 69.60 if we kind of scale up here. stall out at 65. I don't know if you guys have noticed. I have 69.65 has been attracting a lot of interest for whatever reason. Well, the reason I'm going to guess is that was a closing all-time high was 69.66. So I'm guessing that whatever synthetic, whatever institutional plays are there, hedges, whatever it is, that they're kind of hanging out there. If we get over 69.65, we have what I called it a negative dex ladder. Now I'm calling it chutes and ladders. You might remember the game as a kid. I don't know if they have it in Europe, but in America, they have a game when you're like 3 years old or 5 years old, chutes and ladders, where you kind of climb up the ladder and then you advance, and then suddenly you hit a chute and you go back down. So these are chutes and ladders. Climb the ladder up and then trapdoor back down the chute. And we did that yesterday. It was beautiful. We climbed up the ladder, then we stalled, we climbed down the ladder, and then we went down the chute to kind of the bottom. And so should we get over this 65 thing, you have a chutes and ladders game right up towards 7,000 with a little stall at 85, the intraday all-time high. But this is like a dead zone. There's really nothing there. And 7,000 basically sold, basically stall up there. This 70-10, I'm guessing, is the other side of spreads that were sold here or related to this. I don't know that this is an independent bet on 7,000. Not that it really matters why it's there. To the downside, if the 69.20 breaks, which I'm not expecting, that's roughly the bottom of the expected move anyway. We have this positive supportive cluster down here, 6,900 down towards 68.80.
How do you think, how do you envision the dynamics of the market once it goes up to the 69.80 negative gamma? There's like a cluster there, you see, around 69.80.
Yeah.
All of those.
I envision it similar to yesterday. I envision it, if that happens, it's going to play out a lot like yesterday. Now, if we look at how it played out yesterday, very similar setup. We opened wherever we opened, we climbed the ladder up, and then once we stalled, we kind of, we're trying to keep the 70-75. There was interest there. There was also sold calls up there, so it was a little sticky. Then the 69.60 yesterday was a big negative gamma strike. It was just sitting there at the open, and it was sitting there. And eventually, we kind of climbed the ladder down. Toward the end of the day, we got to the 69.60, and then suddenly below that, there was something at 69.40, I think it was. And we just kind of climbed the same negative gamma ladder down that was providing decay for a while. We just climbed it down. So it wouldn't shock me if we saw something similar today. So let's get back to...
So going up through those negative gamma levels, you see no issue? Those three, you have a cluster of three negative gammas. Yeah.
I see no issue. Should we get over 65? That's the first one. So over 65, climb up, kind of like we did yesterday. And then look at this. We have our buddy 69.60 sitting here today. Not as big, but these negative gammas, first of all, if customers are long them, they're going to monetize them and get out. We saw that happen yesterday too. And then
didn't happen today yet.
Didn't happen today yet. And then 69.60 is like kind of the first thing. We have the round number battle zone. At 69.20, don't take your eyes off that. I'm not predicting that it happens, but we have to see what develops during the day. Now we get options depth provides 10-minute slices, CBOE updates, and in the Discord, shout out to the wise hoot owl who converts it to trades, aggregates it, whatever. And so we see yesterday at 9:58 a.m., 0-day, 69.05, 69, whatever. Put spread, we're catching the iron conduits coming in at the open. We're catching the large trades. We're catching the rolls. I traded off of this later in the day. I missed the call spread in the morning. I got a few of them in. Then this trade I saw come in at 10:50, whatever it was, 10:20. Maybe I put it on 10:30, 69.95. I liked it, and that's all. I did a similar trade right here, 20 wide. And then we get the intraday alerts kind of telling us where things are moving. And that coupled with this, sometimes when I look at this, I can't see exactly what was here, what wasn't there. But then when I pair that with the alert, 1,000 or 1,200 call spreads were sold or bought, or something was rolled up or rolled down, I get a better feel for how we can move. Let me quick jump into the vol space today. I don't want to go too far down the correlation dispersion rabbit hole today, right here, right now. But this is something I'm going to keep my eye on more next week. And real quick, here's the volatility of the S&P constituents. Okay, 37 vol. Common institutional trade is to sell index vol, sell this, and buy constituent volatility. And you could look at it as dispersion. So here's a dispersion. How much is rotating under the hood? And correlation, how much something moves together. So real quick example, explain it. Think of a mobile, that they have hanging in front of the baby's, crib up on top to stimulate them visually, because we want to make sure that our kids are all going to be Nobel Prize winners. And something goes up, something goes down, the mobile stays balanced. So in the correlation trade and in the dispersion trade, Microsoft goes up 3% and Amazon goes down 3%, and everybody's moved, and nothing's really moved within that volatility, and that's how that's captured. When correlation goes up, it's typically everybody going down together. It's usually not everybody going up together. So think of this as rotation. And the rotation is kind of healthy. What we're going to have to watch for is what happens if constituent volatility goes up and correlation goes up. That could be a tell of something dangerous happening. Just another moving part to keep your eyes on. There's another moving part. Sometimes there's nothing there, but we have expiry, we have big tech earnings coming up. So I'm just going to keep my eyeballs on this nuance as well.
I want to add something there.
Sure.
You guys hear me okay?
I hear you good.
Okay. So obviously the concept of the correlation says that, as you said, right, if the constituents are moving, but the index isn't, right, because they're canceling each other, but still they're generating volatility for themselves, then you get this low correlation. But correlation goes up when everything moves in the same direction. So obviously,
exactly. Yep.
Right. So and even more so in a more profound way if everything is moving fast in the same direction. And research has, proved it years over years that when the market drops, it moves faster than when the market goes up. The reason is, human nature saying that when you want out, and you want the remaining cash of your portfolio, you're going to do it fast. But
Yep.
there's a limit to how much you will FOMO chase something, right? So to the upside is weaker than the downside. Obviously, these are nuances, and you can only see this really in deep research. But to the point, so by the time these indexes will show correlation, we will already feel the spikes in volatility, and we'll see the down moves before these indexes will actually show the correlation is, picking up or something like that. These are all the same as implied volatility, which is the most accurate that we can rely on, unless anyone has a better model. But the implied volatility will advance this before everything moves in the same direction. The IV will already hint on these things, but like any other indexes that peak, right? The IV can stay for a very short time above 40, but can stay for weeks and months under 10 or under 12, right? So correlation the same. If you look at those charts, you'll see that
Yep.
when everything is moving together, then it peaks, and then it can stay down for a very long time, just like the IVs, right? And also you have VIX of VIX and all those things. So you got it covered for so many angles. It's not that the correlation will add something special to what you already follow and feel.
Yeah, I find that looking at the divergence can tell me when it might tip. I mean, let me put it this way: you get a warning sign that, wait a minute, something might be tipping a little bit. And obviously, it all has to be taken in
Divergence
context with
between what?
everything else, huh?
Divergence between what?
When you start to see constituent volatility going up and correlation going up and not going crazy, like we saw it a little bit here, we saw it a little bit here. It might be telling us that, oh, look, something might be happening, it might be getting ready to happen. And
Okay,
so,
got it. Yeah,
and
yeah.
you're standing on the watchtower, so you're keeping it.
Yeah, I agree. Yeah, could be.
Yeah. So, so it's not, oh, this is all you have to watch and that's it, and go home. You know what I mean?
Yeah,
It's
no, I agree.
obviously
I
just one
mean,
more piece
this
of the puzzle.
from my perspective, because I have a lot of option positions, I actually feel I don't feel, I see if the IV is moving or not and where exactly it's moving over the skew and over the DTs. Because once you have a large portfolio of options, then you can see, P&L doesn't lie, right? So people
Right,
might
right.
talk about this going up, that going down, VIX, mix, but eventually, the P&L shows you exactly which portion of the
That's
skew
true.
and
That's
which
true.
DT is actually moving in terms of IV, and all the rest is just noise.
That's true. That's a good way to look at it. Your portfolio will tell you. So
I
to
even
answer the question, so will VIX notify us of a Trump tweet with a huge candle? Yes, right after it happens. Right after it
Well,
happens.
yes and no. No, sometimes we know that the U.S. is full of insider trading and
That's
some
true too. That's true too. Good point.
shady,
You might get a
shady
warning sign.
trades, right? Shady trades. So sometimes you might pick up on stuff before it happens, but I doubt anyone will have like the full understanding that will generate the full motivation to actually do something on it, right? When people see something strange, they say, oh, there's something strange, and they're waiting, and then eventually the event happens and people say, oh yeah, I saw it, but I didn't do nothing, right?
Right.
So sometimes you see stuff, but you need to be scattered over a lot of options, a lot of positions throughout the term structure to really see the changes that are like subtle and under the ground, to really see something coming up.
And that's a good point. And I don't know how many people kind of are positioned that way. I know I am to an extent. I know you are more so, where you have different positions in different time frames. And after a while, You just kind of glance at your positions. You see how the options prices are moving and how they're moving, and you just get a feel for what's going on under the hood.
Yeah, and but even more so, I actually, I have a like each month I give away some free trades to the market, right? I scatter, I call them sensors, right? I scatter different pricing over
I do
different
the same thing,
options.
actually. I do the same thing, actually.
And then when I get filled, I know to go long or short on the market. So like I sacrifice, I don't know, $100, $200 on that trade, but by getting filled, I can now with confidence do a directional trade, which is always very risky. So yeah, if you're touching the market and you really have positions, you know stuff way before the VIX shows it or all these types of
That's
aggregated
true.
averages.
That's true. That's true. If you know how to read the structure, so to speak, if you know how to read what you're looking
Yeah, and
at.
also your flies. You have flies all over.
I love
So
flies. I love
your
flies.
P and
My
L,
flies suck.
yeah, your flies, your P&L per fly tells you a lot of information in terms of direction.
And not just the P&L per fly, but when I look at a fly,
Pricing, yeah,
I love sacrificing a fly for 85 cents or something like that, or whatever the price is. And I get to see not just the P&L on the fly, which tend to be kind of resilient. I get to see how each of the three strikes in the fly are moving in relation to each other.
yeah,
And
yeah,
you see, okay, this is up, this is down. You kind of, after a while, to me, the information you get, quantuition, like I say, analytic, quantitative numbers plus that intuition from looking at it, you just kind of start to know after a while.
yeah. And I guess that with time, that's why you migrated to Broken Wing because
Yeah.
90% of the time the upper leg of any fly is a waste of money.
Right, exactly. It's a waste of money, right? You're throwing it away, so you might as well try to,
Yeah,
yeah.
yeah, lose less.
Right, lose less, right. Pay less for the info.
Exactly. Yeah, it's actually buying. It's like paying for order floor, so we're paying for information.
Right. And usually, like I said, even when I'm kind of wrong on the flies, when they're like these, probes, these spy probes, I can typically get out with a small loss or a small win if I'm just paying attention to them. A lot of times I don't pay attention to them. I just glance at them. Usually they're pretty resilient.
Yeah, yeah. If you're on it all day and you have the patience, I generally rather do ratio spreads that cost me nothing
Right,
and just
ratio
don't
is a
touch
whole other
them.
story. Yeah.
Don't touch them. Yeah. Otherwise, it's too much nonsense.
So just for example, I'm not sure where I have it. So here's a fly that I put on, I don't even know when, a put fly. Oh yeah, I put this on recently after the gap fill, right? When the gap fill moved up, and it's down $2, it's down $12, it's flat. I didn't put this on to really make money, although if we get to the gap fill, it'll do me some good. But I'm just showing you this more to show you just how resilient they are. Or I have
Which
another one.
what is the strike? What is the middle strike there?
25. It's just a 50 wide buying the 68.75, kind of where that initial gap fill thing was that people
Yeah.
were talking about. And I got another one. Where is it?
This could make money today by
Yeah, it
mistake.
could make right. And if by mistake it makes a couple $100, I won't be upset either. I might have.
Yeah, if the market doesn't take out the 65, 75, it could retest the 40. And when it goes down to 40, if it goes fast enough, then your fly here will make money.
Right, we'll print. And I have a similar one here. Now look at oh no, I must have rolled up. I had a 50, I have it somewhere. I have a 50, same thing, 50 wide, but with the 50, when that was the gap fill like 3 weeks ago, And when I find that it's also down 17 cents or something, 17 bucks or something. My point being that these things are resilient is kind of my main point.
Yeah, they tend to move only 2-3 days before expiration. They start to,
Right.
sometimes it's mainly decay. So depending on the spot. But yeah, you're an expert in these. I mean, you have so many and you have so much experience with these that, I thought about it yesterday, right? I mean, you had a lower fly around 40, which the market went to 40, and then you had
Yep.
an upper fly at 65, 70, where the market went up to 65, 70.
Yeah. And let's use that as a segue to look at the chain. So where's the market telling us it might go today? We could
Only
stall
one
at
way.
65. We could climb that ladder kind of like we did yesterday. So, maybe, so now it depends how you want to play it. You want to get to 60 and you're going to get to stall here and try and get the acceleration into here? Or do you want to maybe get this, get something right above here, a 70, whatever, 70, 85, 7,000, depending on what that costs, to try and get the acceleration into here? Or do you want to sell the 7,000 and get like an 80 or 85 and see if the acceleration up into here, if the gamma of your long strike will print for you? So there's a few ways to think about it. To the downside, we have the 60. If we have nothing going on here, here's our eventual target. Here it's not as clean, but let's take a look. Let's just take a look at some potential flies for today. Let's look at the downside first. We think we could accelerate, what was it, 60? 50 is really nothing going on at 50. So let's try and buy the round number or near it. Oh no, we're going to open there, so that's going to be kind of too expensive. So let's
You won the first leg. You won the first leg, whether it's a call or a put. The first leg, yeah. You want
yeah,
it to be right at where the negative gamma starts, because
right,
once you drop
exactly,
in the negative gamma, it goes fast, right?
right,
You want the
right.
market to go fast through your first leg and not stall there. Otherwise, you're fucked.
Right. You're right. The last thing you want is for it to stall. And so, I mean, the 60, which is where that's already in the money. So the 20 is the next acceleration. I don't think that we get there. So something like this might work. Something like this, selling the expected move is 30.0, somewhere in here. For 65 cents, this isn't bad, although like you said, we might get to the 20, but I don't think so.
Well, that's the only main target to the
Right,
downside. That's the
right,
first target to the downside based on your option
right.
depth thing.
And so we could try a cheapie. Now this is nice, 35 cents for a cheap 10 wide. We might even want to kind of catch the acceleration into it. What does a 15 wide? 15 wide for 75 cents, 80 cents gives me a lot of, the 15 wide for that cheap gives me a lot of play.
You just filled it.
No, I can't. I just put it in and we'll see if it fills at the open.
Oh, okay.
If IBKR, you could fill it. And on top, whoop, on top,
On
let's
top,
just
we
kind of,
saw the negative gamma started at 60 all the way to 80, right? So you want the leg to be at 60.
well,
Okay.
65 was a positive gamma strike. So we want to see, so here's where it gets tricky, because if we keep stalling here, then you might not get that acceleration. So it depends how you want to play it.
Go back to the option depth for a second.
Yeah. Okay. So let's talk this through, folks.
I mean, the way you design the fly around the option depths is super smart in a good way. It increases your, your
Right.
odds.
Okay. So let's look at the option depth. Okay.
Yeah.
So we have the 60 where acceleration should start, which is kind of at the money now,
And then you immediately stall.
and you immediately stall. So you want to say, okay, so the question is, if I buy, say, the 70 or 75, and we stall, what happens? Well, let's
Well,
think it through. Let's think it
you
through.
can
So
you could do.
what happens is, yes, your long option doesn't appreciate, but your two short options do. So you can sit through the stall. You can sit through the stall.
Yeah, but you see, you have that cluster of negative gamma,
Right.
and then you have a larger cluster of positive gamma. I'm going to do a ratio spread rather than, I'm not even going to do a broken wing. I'm just going to do 1-on-2, starting below that, like let's say long 60, and trying
Okay.
to
So you're
finance.
okay. So you're going for the kill, so to speak.
Well, depends on how, if I can finance it. I'm willing to pay, 75% of the 60. So buy that, sell two against that, and I'm willing to pay partial for that. So I take the risk because I expect if the market accelerates through the negative gamma, it will stall at the 7,000, of course. That will not be breached that easily without news,
Right.
right?
See, I don't see a great call fly here the way I like to play them.
Well, everybody's sitting on that, so it's expensive.
Right. So I don't see a great one. What can I tell you? I'm willing. I'm willing to sell. Let me see what it looks like all the way up here. See, this isn't bad for 55 cents either if I could get some acceleration up into it.
Oh, you will. If the market takes out the 65, right? That positive gamma you have there, then it goes up like a magnet to 7,000, 7,005.
I'm going to do that for 50 cents too, just to see.
Yeah, that's the cost for the lottos, for the upside
No,
and downside, I guess.
right. For the lottos and for the Intel.
For the Intel, right. Now, what happens if you're doing new stuff and it overrides existing positions?
What do you mean by overrides?
Like, let's say you had the fly from yesterday for today, and now you added another fly. So those, the account has now.
I try to be careful on not to overlay too much crap on top of crap. It's
Yeah.
basically and that's sometimes a challenge. Sometimes in the heat of the moment, or I'm, doing something like I'm doing there, and I forget, oh, wait a minute. All right, I don't forget, I don't notice that, oh, I have this here and this there, and they kind of fight with each other.
Yeah,
So that does happen. Yeah, that does
although I
happen.
think,
Yeah.
although I think that because each of them represents your current view, right? It doesn't necessarily cancels out the previous one. So even if you pile up and suddenly you have this crazy, type of strangle payoff chart, which you didn't necessarily mean, I think it has
They
all
tend
the.
to work out. Yeah, they tend to
Exactly,
work
yeah,
out.
because it represents your total views up to this point. So it should work.
Yep, they tend to
Maybe
work out.
more work on the hedge side, but it should work.
Yeah. Okay, so let me try to answer a couple questions here. So what time do the contracts expire? So
At the open.
used to be that you couldn't trade the AM after the close on Thursday. They changed the rules. Now they could trade them till 9:15 when trading stops, but the settlement price, what that officially settles out as, is the 9:30 a.m. open. The 9:30 a.m. open often the official price doesn't come out 2 minutes later, 5 minutes later, when they do the math of the official opening prices of all the constituents. I was stuck in an AM expiry once, like, I don't know, in 21, 22, during COVID, I forget exactly one, where it took almost 15 minutes for the official price to come out. Doesn't happen usually. And that was that kind of a high volatility, crazy. It was in October on top of that. If you guys remember October in those days, it was a crazy October AM expiry, and I had some kind of Frankenstein there. And but typically, let's go to the usual, not the crazy. The usual is going to be 5 minutes when we get the official price, and then we kind of go on from there. So 9:15 is the last, is when you can't trade it anymore. 10:30 is the settlement number. And what do you also call a good entry time for the AM expirations? Wait till it ended up with premiums. A good. I don't like to trade the AMs that much because I don't like to be trapped. But if I'm going to trade the AMs, I like to get them early in, like right at the open the day before, and I almost consider it mentally like a zero DTE, or a few days in advance where I have time to dance. I don't want to be trapped in an AM with overnight news flow.
Also, the AM is much, the multiplier is not 100, it's more.
Not an option. An option to multiply is the same.
I think the exposure is higher than the
The
regular.
exposure is higher, but now
Let me check it. I'll
now
check it.
the opposite side of that, though, is the good part about the AM is there's a lot of liquidity there. We know where the chunky numbers are. So you have a good chance of knowing that. Yeah, I'm not sure. I mean, the multiplier is always the same for SPX options. It's always whatever the premium is times, whatever it is, $10, whatever.
Right. Sorry. Yeah. I mix it up with the NDX. Yeah, you're right.
Yeah, right. NDX and NQ, and that's the futures
No, the
thing has
NDX
a
is
whole crazy
huge.
different multipliers here.
Yeah, the NDX is huge.
Okay, last thing, and then I'm gonna stop. So yesterday at the close, whoops. Well, not today. Guess this was yesterday. Okay, yesterday, we were playing around and did just a couple of these. I did more of them in my regular account. Looking kind of where the gamma levels were, and this was an iron condor for 95 cents. Somebody was asking about a 10 wide. I think it might have been you. That was asking. Somebody was asking about a 10 wide. And this looked good to me. And so I put in one as an iron condor to get filled, and one each side. And this must have been a trade I had on from before that closed at the open yesterday, see 9:30 a.m. And so now I have the trades working to close. I have the iron condor. If you just close the one piece as a whole piece, 40 cents is a little more than 50% profit. Or I can just close it out right now with 2/3. The puts look, and then I have each one separately. The puts look like they're going to close out at 20 cents. The calls are basically break even. So your profit here is on that, unless you like the calls up there, in which case you keep it. Unless you think that that's a good strike to be in. Anyway, that's it for now. And
Let's go trading.
Huh?
Let's go trading.
Let's go trade and make some money.
Right. Yeah, I think the approach, I think it's very interesting how you match the positions against the option depth. So yeah, we can deeper dive next time on this and try to simulate the actual price action dynamics through the negative and positive clusters, and how that affects or motivates the correct positioning of whatever spread, a
Right,
fly.
and also, let me just add to that, intraday, when we see changes, a lot of times there's good flying opportunities that came up. When I saw us heading to, I didn't take the trade, I'm a cheapskate. When I saw us failing at that 75, 70, 65, heading toward the 60, a 60 long or 50 long even, because we're going to accelerate through it, fly, the one we talked about in the morning, you could have put it on again later in the day, even cheaper. So yeah, anyway, it's fun. The flies are fun. And if nothing else, I think the flies are a good teaching tool for yourself. I think when you start putting these flies on, you start to see how things will move. Anyway, I can talk about this shit all day, which I do on the Discord. And take care, everybody. Trade safe.
Bye bye.
And, let me see it. Well, the quote on top kept failing, right? Yep. Right at the 80, 85. You remember that, right? Kept failing. They couldn't crack through that. Exactly. All right. Even when they brought back the short calls or somebody, or they got eroded, we still couldn't break through it. And what ended up happening was that positive gamma mean reversion, where you bounce off it and get sucked back to it, that was gone. Actually, it ended up not opening up the lid, but actually ended up closing the mean reversion back toward it and helping us go back down. If you catch my drift. Anyway, we're going to end